Price pushes against resistance. A large green candle closes above it. Volume spikes to 3 times the average. You enter. This looks like confirmation, but the next candle stalls. The one after it rejects with a long upper wick. Then price falls back below the level. You are trapped. The volume was real. But high volume at resistance can also mean sellers were absorbing every buy order at that level. The participation was real. The outcome was rejection, not continuation. This is the gap most traders never close. They learn to read volume, effort versus result, the key patterns, but they never build a framework for using volume in trading decisions. In the previous video, we covered the foundation, how to read volume correctly. This video is the practical playbook, how to use volume to judge a trend, filter a pullback, confirm a breakout, detect a trap, and manage an open trade. 4 elements: price, volume, context, reaction. Every decision in this video comes back to that. But before we use volume for any of this, we need one thing first. Volume is never high or low by itself. It is only high or low compared to what is normal. 1 million shares may be extreme for a small stock. For a large cap, it is a quiet day. A volume spike at the market open may be routine. The same spike during a quiet afternoon consolidation is much more significant. So instead of asking, is volume high, ask, is this volume unusual compared to its recent average? That is relative volume. You are comparing the current bar to what is normal for this asset, this time frame, and this part of the session. This one check alone would have changed the opening scenario. If the trader in the opening had noticed that the volume spike was not unusual for the opening session, that it happens every morning at that level, the breakout would have looked less convincing. Relative volume is the prerequisite. If volume is not above normal, it is not confirming anything new. If it is 2 or 3 times the average during a quiet session, that tells you something real is happening. This is the starting point for everything that follows. Now that you have a baseline, the first real application is one most traders skip entirely. A healthy trend is not just price moving in one direction. A healthy trend has participation behind it. In a strong uptrend, here is what volume should tell you. When buyers push price higher, breaking levels, making new highs, volume expands. Buyers are committing capital at higher prices. Participation increases in the direction of the move. When price pulls back, volume contracts. Sellers are not aggressive. The correction happens because buyers are pausing, not because sellers are taking control. This is how you read buyer-seller balance inside a trend. Expanding volume on impulse, contracting volume on correction. Buyers show strength when it matters. Sellers show weakness when they get their chance. Now here is the practical application. Imagine 4 pushes higher in an uptrend. Push 1, strong volume. Push 2, even stronger. Pullbacks are light. Push 3, volume is slightly weaker than push 2. Price still makes a new high. Push 4, volume is clearly weaker. Price barely makes a new high. The chart still looks bullish. The candles are still green. But fewer traders are supporting each new high. That is not a signal to short the market. Volume divergence like this can persist for weeks before price fully turns. Do not use it to predict the exact top. But it is a confidence signal. It tells you the trend may be maturing. Stop adding to your position when participation is fading. Protect open profits. Wait for the next pullback and see whether buyers return with strength before committing more. The practical rule. A strong trend has volume expanding on each push. A weakening trend shows declining participation while price still moves up. Use this to adjust your confidence, not to fight the trend. Most traders understand that trends can weaken. But here is where the real decision happens. Price is pulling back right now. And most traders treat every pullback the same. That is a mistake. Because volume tells you whether this pullback is a rest or a fight. Not every pullback is the same. Some are opportunities. Some are warnings. Volume tells you the difference. A healthy pullback looks like this. Price is in an uptrend. Buyers have been pushing higher with expanding volume. Then price starts to correct. Look at the volume during the correction. The bars are smaller, below average. The candles may be smaller too. What does this tell you about the sellers? They are present, but they are not aggressive. They are not committing serious capital to push price down. This is not an attack on the trend. Price is moving lower because buyers are pausing, not because sellers are taking control. Now watch what happens at support. Price reaches a logical level, a previous breakout area, a prior swing high, a zone where buyers stepped in before. Volume picks up. A bullish candle appears with above-average participation. Buyers are stepping back in. That is a constructive pullback. Low volume correction, structure intact, volume expansion at support, and renewed buyer commitment. Three things must align. Structure holds, volume stays light during the drop, and buyers show up again at support. If any of these is missing, the setup is weaker. Now compare that to a dangerous pullback. Same uptrend. Price starts correcting. But this time, volume bars are large, above average, maybe increasing with each bearish candle. The candles are bigger. Price is falling with momentum. Then price breaks a recent higher low. What does this tell you? Sellers are not just present. They are aggressive. They are committing capital. They have enough strength to break the structure that was holding the uptrend together. This is no longer a rest. This is a shift in the buyer-seller balance. It does not guarantee a reversal. The trend may recover. But buying this pullback means buying while sellers are actively attacking. The safer approach: wait for selling volume to fade. Wait for structure to stabilize. Wait for buyers to show renewed strength before committing your capital. The practical rule: in an uptrend, low-volume pullback with intact structure and buyer re-engagement is usually an opportunity. High-volume pullback breaking structure is a warning to step aside. In a downtrend, low-volume bounces are normal corrections for the short side. High-volume bounces breaking lower highs are a warning that buyers may be gaining control. Volume does not just tell you the pullback is happening. It tells you who is behind it and how hard they are trying. That is the difference between a pause and a threat. Now you can judge trend health and pullback quality. But the next situation is where the most money is lost, and the most traders get trapped: breakouts. Breakouts are where many traders lose the most money. Not because breakouts are bad setups, but because most traders only look at one candle and decide. A real breakout is not a single moment. It is a process. 4 parts. Part 1. Compression. Before a strong breakout, price builds pressure. It moves sideways under resistance. Maybe it forms higher lows. Maybe it tightens into a narrower range. During this phase, volume contracts. The market is waiting. Energy is building. This matters. A breakout after compression carries more weight than a random spike above a level. Part 2. Expansion. Price breaks through. The candle closes above resistance. Volume expands, significantly above the recent average. This tells you participation is entering the market as price moves into new territory. Broad commitment, not just one buyer. Part 3. Acceptance. After the breakout, price should hold the new level. In practice, this means price may pull back to touch the old resistance, and instead of breaking back below, it holds and bounces. Old resistance becomes new support. The key detail: volume on this retest should be lighter than volume on the breakout. That tells you the sellers testing the level are weaker than the buyers who broke it. Part 4. Continuation. After the retest, price moves higher again with renewed volume. This confirms the breakout has follow-through. Buyers are still present. That is the full structure: compression, expansion, acceptance, continuation. Now here is the critical point about entry timing. The trade idea does not form at expansion. Entering on the breakout candle is chasing. The trade idea forms at acceptance, when price retests the level, holds it, and volume confirms that sellers cannot push it back. That is where you have evidence. That is where risk is defined. Now, most breakouts do not complete all 4 phases, and this is exactly where the trap forms. There are 3 failure modes. Each looks different. Each has different volume characteristics. The first failure mode: low volume breakout. Price crosses above resistance, but volume does not expand. It stays average or below. The candle may close above the level, but it is not backed by broad participation. This is a weak breakout. Without unusual commitment, the level may not hold. Treat it with caution. The second failure mode is more dangerous because it looks like confirmation. Price breaks above resistance, volume spikes. It looks powerful. But here is the counterintuitive part. High volume at a breakout is supposed to confirm strength. But sometimes high volume is the trap. The candle closes with a long upper wick, or it closes back below the level despite heavy participation. What happened? Buyers were active. The volume proves it, but sellers were absorbing those buy orders at the level. Both sides were fighting, and sellers held their ground. Remember effort versus result from the previous video. This is high effort, no result, or high effort, negative result. Volume was not confirming strength. Volume was revealing rejection. This is why you cannot judge a breakout by the volume bar alone. You must also check where the candle closes and what happens next. The third failure mode, failure to hold. Price breaks out. Volume is decent. The candle closes above. But the next candle, or the one after, falls back below the level. The breakout cannot sustain itself. Now every trader who entered is trapped. When they realize the breakout has failed, they close positions. That selling pressure fuels the move in the opposite direction. This is why failed breakouts often reverse violently. Trapped traders become fuel for the other side. So when you evaluate a breakout, ask, was there compression before? Did volume expand significantly? Did the candle close strong? Did price hold the level on the retest? Was retest volume lighter than breakout volume? Did price continue with renewed participation? And if the breakout fails, where are you wrong? Where do you exit? Volume helps you recognize which breakouts have real support and which ones are built on weak foundations. But it does not guarantee the trade will work. Your job is not to find certainty. Your job is to find better evidence. Volume helps you before the trade. But what about after you're already in? Most traders think about volume before they enter. But once they are in, they stop reading the market. Volume does not stop being useful after entry. It tells you whether your thesis is still supported and when conditions are changing. Let me walk you through a long trade in 4 phases. You bought a pullback in a healthy uptrend. Volume confirmed the entry, light pullback, structure intact, buyers returned at support. Now you are managing the position. The first phase, confirmation. Price moves in your favor. The impulse push happens with healthy volume. Buyers are active. The next small correction is light. Structure holds. Volume is confirming your thesis. The trade is working as expected. Decision. Hold the trade. Nothing has changed. The second phase, caution. Price pushes higher again. But this push has weaker volume than the previous one. Your trade is still profitable. Price is still moving up. But participation is fading. Decision. Stop adding to the position. Do not increase size when the market is showing less commitment. Consider moving your stop to break even or to a logical level that protects some profit. You are not exiting. You are adjusting to reduced conviction. The third phase, warning. Price reaches a significant resistance area. Volume spikes, but the candle leaves a long upper wick. Buyers were active. The volume shows it. But the market rejected higher prices at this level. Decision. Take partial profits or tighten your stop significantly. If buyers cannot push through resistance on strong volume, the trade may not have much more room in this direction. The fourth phase, exit thesis. After the rejection at resistance, price pulls back, but this time the pullback has strong selling volume, and price breaks a recent higher low. The structure of your trend is damaged. Sellers are aggressive. The higher low that defined your uptrend is gone. Decision. The conditions that supported your trade are no longer present. The thesis may be over. Exit or accept that you are now holding without structural support. Now the same logic, if you are short. Imagine you shorted at resistance after a breakdown. Volume confirmed seller dominance. If price continues lower with expanding volume and bounces are weak, your thesis is confirmed. Hold. But if price bounces from support with strong buying volume, breaks above a recent lower high, and buyers show real commitment. The short thesis is weakening. That is not a prediction that price will reverse. It is information that your original conditions have changed. Respond to the information. Do not argue with it. The key idea: volume is not just an entry tool, it is a management tool. It helps you hold with confidence when conditions support you. It helps you reduce when conviction fades. It helps you protect when rejection appears. And it tells you when the market no longer confirms your thesis. Now let's bring this together into something you can use immediately. Before your next trade, run these 6 checks. 1. Is this volume unusual? Compare it to the recent average. If it is not above normal for this asset, this time frame, and this part of the session, it may not be telling you anything new. 2. Where is this volume happening? At support, at resistance, during a pullback, during a breakout, after a long trend, inside a range? Location changes the meaning of the same volume bar. 3. Is volume confirming the move or diverging from it? Volume expanding with price confirms direction. Volume fading while price continues warns of weakening participation. 4. How does price react after the volume appears? This is the most important question. Does price continue, reject, hold the level, break back into the range? Volume tells you who showed up. Reaction tells you who won. 5. What type of volume behavior is this? Is it trend confirmation, pullback weakness, breakout expansion, fakeout rejection, climax, absorption? Categorizing the behavior helps you respond instead of guessing. 6. Where am I wrong? Volume improves your analysis. It does not remove risk. If the breakout returns into the range, you are wrong. If the pullback breaks structure on strong volume, the trend thesis is wrong. If the rejection does not confirm, step away. Every setup still needs an exit point defined before entry. That is your playbook. One more thing worth noting. Volume data is not identical across all markets. Stocks have exchange-reported share volume. Futures have contract volume. Spot Forex typically uses tick volume because there is no centralized exchange. Crypto volume varies between exchanges. The principles in this video apply across markets. But understand what your platform is showing you. Do not treat tick volume the same way you treat real share volume without adjusting your confidence level. The final point is simple. Volume is not a buy button. It is not a sell button. It is a decision filter. It tells you whether conditions support your trade idea. And when those conditions change, price, volume, context, reaction. When you combine all 4, you stop reacting to random spikes. You start reading the market with structure. And that is the real value of volume in trading. This video is for educational purposes only and is not financial advice. Trading involves risk. Always do your own research, manage your risk, and take full responsibility for your trading decisions.